Good afternoon, everyone, and thanks for joining us today. We thought it was important to continue this tradition, even if virtual. Some quick housekeeping items. Please note that this presentation is being recorded and will be publicly available on our website for a period of time following the presentation. And some of our comments today may contain forward-looking statements. Please refer to our SEC filings for information about related risks. When we open today's discussion to Q&A, those on the screen, please feel free to ask questions verbally. Everyone else could use the question and answer functionality on the bottom of their screens. With that, I will turn the call over to Jim.
Thank you, Stacy, and thanks everybody for joining. I did want to just mention for those of you who haven't done this with us before, this is our download by our leasing team of some of the meetings and interactions that we've had with tenants that we hope provides you with perhaps a little bit more context in terms of what we're seeing on the front lines, what tenants are expanding across what categories, and what are we seeing from tenants as we emerge from COVID. We have a great team assembled for you. In addition to Angela and Stacy and myself, whom you see all the time, we have Brian Finnegan, our Chief Revenue Officer. And with Brian is David Gerstenhaber, our Head of National Accounts, along with Tanya Creekmore and Eve Sembler, who are also within National Accounts focused on peripheral leasing and out parcels and have a great perspective on a number of different tenants. One thing I would highlight for everybody that I think is a bit different about Brixmor is that our approach to the market does focus on making sure that our national accounts team has great penetration, access, and coverage of the national and regional tenants with whom we do so much business. And these folks that you have with you today on the screen are big drivers of our consistent outperformance from a leasing perspective. So without much further ado, I thought I'd turn it over to Brian and let's talk about what we're seeing.
Thanks, Jim. And like Stacy said, we appreciate having all of you here today. Normally, as Jim mentioned, we would be having this discussion with all of you at Recon in Las Vegas. And while we regret not being there in person, as we have in the past, we continue to have great feedback from our team, this time from the over 300 meetings that we had at our virtual Recon conference that we put on over the last few days, along with the many portfolio reviews and virtual conferences that we've had over the past year. This format doesn't replace in-person interaction, but it's been very effective for our team in presenting opportunities and continuing to grow our relationships with our retailers. And what's been consistent over the past year is the broad depth of demand to be in our centers. And what's exciting for us as a team is that demand continues to grow as we reinvest and reinvent our properties. So for today, I'm going to give a brief overview of how we're well positioned to continue to outperform in the recovery due to our structure, as Jim mentioned, what we're seeing in terms of the different formats and prototypes, and then really the sheer depth of the new tenants that we've added to the portfolio over the past few years. And then you'll hear from Eve, Tanya, and David on some of the trends that they heard from their retail partners over the past few days. And then we'll take some questions from the audience and from our guests as well. Starting on this slide, as Jim mentioned, our structure is unique in terms of how we approach our national retailer relationships, in that our national account team, which David oversees and Tanya and Eve are a critical part of, support our local teams by having long-standing, very solid relationships with key national and regional retailers. This combination of a local and national approach, it gives us a competitive advantage. It's not simply a regional versus corporate structure. It's a collaboration of the two. And what it allows us to do is identify short and long-term opportunities and then really streamline the deal flow process, dramatically cutting down the time from our initial discussions to store opening with conforming lease documents and real alignment through the operating platform, both on the retailer and on the Brixmor side. And through these relationships with key tenants, we're able to identify new markets and new prototypes, oftentimes well ahead of when they're announced or when they're being discussed, so that we can create opportunities not just today, but others that are coming 3 to 5 years out. And in addition to the new opportunities that the team is in constant dialogue on, they're also in dialogue on our existing store fleet. understanding how best to position their partners for success long term, whether that's expanding, downsizing, or reposition a store. The trust and candor that the team has with these retailers allows us to be very proactive, well ahead of when a retailer makes a decision, as you'll see with some of the examples that we have here in another slide. The other key component to their jobs is securing use and development waivers, which for this team has been a big part of what they've been doing over the last year, and it's been able to unlock tremendous value across the portfolio. We were able to finalize a number of those consents during some of the challenging conversations that this team had with their key retail partners during the pandemic. And I think it speaks to the level of those relationships that we're able to finalize those agreements, unlock value, and then quickly pivot to new leasing discussions, which has really been demonstrated by the incredibly strong leasing activity that you've seen from our team at the end of last year and really to start this year. Jack, can you go to the next slide? These are just a few of the key areas in which the team is focused and what you'll hear more from them on. First, as it relates to new formats and prototypes, Burlington Stores has really reinvented themselves as a company the last few years, and we've been at the forefront of that expansion in several ways. We've completed 15 new leases with them over the past 5 years. Included within that, we opened their first 25,000 square foot prototype in Los Angeles, California, earlier this year. Understanding that they had a desire to be in a smaller footprint, we've been able to relocate 2 stores to reinvestment projects that we've had in the Chicago and Tampa area in the last 2 years as well. And we've also been incredibly proactive on their downsize program. We've downsized 3 of their larger locations, 2 of which to allow new Sprout stores. And it's really a great example of how we've adapted as their real estate needs have changed. We're also seeing new concepts from our traditional open air retailers. In a meeting that Jim, Angela, and I had this afternoon with Dick's Sporting Goods, we discussed opportunities for 3 new concepts. One, the 100,000 square foot House of Sport that they just opened in Knoxville and upstate New York, the warehouse off-price concept that they have, as well as the Public Lands REI type concept that they announced last year. In addition, we've been engaged with Dollar General on their Pop Shelf concept as they look to aggressively expand that throughout the Southeast. Another area that Jim touched on, in which Tanya and Eve spend the bulk of their time, is in the outparcel space. We are seeing incredible demand from restaurants, banks, medical uses, along with other concepts, and freeing up those development rights for these projects has been something we've been laser focused on unlocking in our national tenant discussions in recent years. A few of the examples here, by the end of this year, Tanya will have tripled our fleet with Chipotle over the last 3 years. And we're working very closely with them to add Chipotle drive-up windows to as many locations as we can. One of Eve's key tenants is Starbucks. She works very closely with them. She'll share how we worked with them on a brand new interior design at our Newtown development, the first one that they did in the country, which they're now rolling out across the other locations in the country. We're also working with them to design better drive-through flow in new deals that we have coming down the pike. In terms of new concepts and markets, I'd highlight the lease that we signed in the fourth quarter with Wren Kitchens. It's the UK's largest kitchen showroom operator. It's going to be their 4th store in the US, located in a ShopRite center that we own out on Long Island. They plan to open another 30 stores this year. We've also been incredibly active with TJX as they expand their Sierra and HomeSense concepts. And then from an off-mall perspective, we're not just hearing tenants talk about their desire to move to open air. You're seeing it in our results. All these tenants we've executed leases with and have strong pipelines with, as well as several others. And we expect this trend to continue, and that our team is really well positioned to capitalize on. Jack, do you want to head to the next slide? And in addition to some of the tenants and trends that I mentioned, we're excited that we're one of the top 2 landlords in the REIT peer group to some of the best open air retailers in the space. It not only gives us access due to scale, but also helps us attract best-in-class concepts to our centers. And then speaking of best-in-class concepts, Jack, if you go to the last slide here, I mean, wow, this demonstrates just the breadth of demand. These are all just brand new concepts that we've added to our portfolio in the last 3 years. And whether that's in the grocery, home, medical, restaurant categories, and several others that you see here, many of these concepts came as a direct result of the investments that we're making in our properties. Tenants like our first J. McLaughlin deal that we did at our Marco Island redevelopment in Florida, where they tested out a pop-up store, saw the investment that we were making, the tenants that we were able to bring in, and converted that to a long-term lease. We're working on a similar deal with Vineyard Vines right now, or actually signed a similar deal with Vineyard Vines right now. Or the quality restaurant operators we've added, like Iron Hill Brewery and Hampton Social and Chop. All of these were significant merchandise upgrades or additions that we had at reinvestment assets. And I think overall, I think the depth of this just speaks to the level of demand and the wide range of categories that continues to enable us to outperform. So with that, I thought we'd turn it over to the team to see some of the trends and tenants that they've heard from over the past few days, because we certainly did hear a lot in the over 300 meetings that we have, and certainly have a ton to follow up on. So why don't we start, David, with you? What are some of the things that came out of your meetings this week?
Yeah, thanks, Brian. Appreciate it. And hey, everybody. So broadly across all my meetings for the last 2 days, sentiment has been very optimistic. Obviously, the more the population's getting vaccinated, the government restrictions are getting lifted, and stimulus packages are effectively recapitalizing the consumer. So we're seeing great results from all the retailers. We're seeing talks about new markets, new concepts, white space, generally very optimistic. Like Brian mentioned, we're seeing demand from a wide breadth of categories like value, like grocery, pet supplies, home improvement. And when I think about supply and demand, there's really no new supply coming online, and there's very strong demand from these retailers to reap the benefits that our traffic, that the traffic at our suburban centers is driving with daily needs anchors every day. So retailers are looking for visibility, they're looking for access, they're looking for convenience and ease of parking, and they're looking for locations that are in close proximity to the rooftops. And frankly, these are the characteristics that our asset class can offer, and we own them all across the country. So all these factors are really allowing us to really gain our share of new store openings with these retailers.
Thanks, David. Tanya, how about from you?
Yeah, thanks, Brian. I'd echo really almost everything David said, and would add to it, because our focus, Eve and I, is often on the peripheral land and out parcels, is that the increased demand and competition for restaurant spaces with drive-throughs was a huge focus, and us being able to address that flexibility, both that geographically throughout our portfolio, but also to get those consents and to partner with these retailers to adjust as they react to the marketplace and to new prototypes. That seemed to be really well received, and it's just a very competitive marketplace out there today.
Thanks, Tanya. Eve, how about from you?
Yeah, I mean, definitely it's very competitive. It almost feels like everyone is just going and going and going at the same time, which is great. And I really wanted to touch on kind of what Brian mentioned in his opening, which was a specific conversation we had with Starbucks, where they told us that they, had so much increased traffic to their drive-through, specifically at their store at Newtown, Pennsylvania, and Village at Newtown, and innovated. They reoriented the entire interior to optimize the drive-through flow. And as a result, they decreased window wait times by 25%. They were so impressed by what they were able to do there at our shopping center. They're going to roll it out to 150 of their cafes and integrate it into their new cafe design, which is just so exciting that we were able to partner with them on that in Newtown. And we're also collaborating with Starbucks specifically on double drive-through design, which is very exciting. So one of the big themes that I heard from the retailers that I work with, specifically restaurants, is drive-throughs. The ones that have them want a second. They want to optimize their mobile ordering to fulfill those customers through the second drive-through lane. Those that didn't have them maybe want to start adding them. Hearing that from Shake Shack, they're launching their drive-through in Orlando, and we'll be adding more. And then, there's a whole category of drive-through only coffee and tea operators that is really pushing and expanding right now. They take a smaller portion of the parking field. So it's very exciting to partner with them and hear about their growth as well.
Awesome. Thanks, Eva. I was reminded of the meeting that we had with a retailer who was talking about, we got a question about them allowing us to do out parcel developments. And what they said was, look, we see the traffic that Panera is bringing there. And as long as it doesn't impact our parking greatly and there's a big field, we've been really accommodating. We're certainly finding that throughout in our national tenant discussions, particularly with the tenants that you're highlighting. I want to go back to David and we were preparing for this, David, you're putting together some of your marketing packages that included a lot of data, right? How are you using that, and how'd that come up maybe in some of your meetings today in terms of some of the data tools that you're using?
Yeah, thanks, Brian. One of my favorite topics, as you know. So, we're a very data-driven industry on both sides, landlord and tenant side. And as the data collection resources have evolved, so is our arsenal of tools. We're using some really cool stuff. One is a geofencing tool that allows us to see what cell phones are coming into assets and into stores within those assets. This gives us an unparalleled look into our trade areas and traffic trends. We're also using an AI-powered void analysis tool that allows us to take the cell phone data and actually find potential tenants to backfill vacancies with it. It helps us match who is a good fit to our center based on a multitude of factors, the demographics that those tenants like, the co-tenancy that those tenants like. It's really not only increased our team's efficiencies, but it's also helped us prospect for new tenants and really focus our canvassing efforts in a more targeted fashion. These tools, they've also allowed us to improve our renewal negotiations. We've leveled the playing field for the first time in a while. By tracking foot traffic trends at the tenant level, we get visibility into store traffic, which correlates into store performance, and we can see how specific stores are performing, understand what type of leverage we have in a renewal conversation. I think it's also important to note that the tools that have been developed, they're really user-friendly interfaces as opposed to just raw data, which it was historically. A deal maker can pull up a property themselves in a software platform and be able to easily look at traffic trends, voids in their market, and with a few keystrokes, they can create marketable data-driven sales pitch presentations. And we've really never had anything like this. So it's really cool and it's yielding results already.
Thanks, David. Tanya and Eve, you both spent time talking about drive-throughs and the demand for that. How significant was that in your discussions here with many of your retailers in terms of how they're changing maybe their drive-through footprints, or overall maybe with some of your retailers that didn't have drive-throughs previously that are now really focused on it?
Absolutely. Eve hit one perfect example as it related to Starbucks creativity and us working with them to determine the best use to the consumer in that particular asset and community. Starbucks by no means is the only one dealing with that. You've got companies like Buffalo Wild Wings that's rolling out BW to go, which is a pickup location that has fewer seats, and they're rolling out the potential for, it's only about 1,500 square feet, a pickup window there, similar to what you see with the Chipotlane that you discussed earlier, Brian. And you see a lot of that. You've got what Eve referenced, you've got tenants that only had one drive-through, now they're going to have two drive-throughs, or they're going to have what they call a very technical engineering term, the loop-de-loop, which is essentially, it's just a creative design to figure out a way to accommodate the interior of the store, but also, people don't think the drive-through window needs to be on the right side of the actual, car and consumer to come through, and also not interrupt the traffic flow of the actual shopping center and the main roads. So those are the types of things that we've married up our internal group with. And we actually had them join meetings today. It's that prevalent. That theme of how can we fit a drive-through here is so prevalent. We literally partnered up with our internal redev team for ICSC meetings today.
Yeah, and building on that, I mean, we've been really hearing that retailers want to adapt and work with us on those drive-throughs. So some that need the drive-through, they're flexible. They'll do a pickup window to get into the right real estate. They'll do a drive-through, a single lane, and if they can get it, they'll do the double drive-through. So we're hearing that flexibility on not only how many drive-through lanes they get, but also the prototype because there is such a demand to work with us on that A+ real estate.
That's great. Eve, why don't we stick with you? I wanted David to chime in on this as well, but I touched on the off-mall program a little bit and what we're seeing. Maybe you had an interesting conversation with one of our tenants, and then maybe David can chime in on that as well.
Yeah, I had a great conversation with Sleep Number, and they are just doing so well in this environment and accelerating their off-mall program, and at the same time increasing their fleet with us. They've tripled in the past few years how many stores we have with Sleep Number. So I found that very encouraging and a huge testament to how we're upgrading the look and feel of our assets, that they want to seek out Brixmor and come to our shopping centers. It was really encouraging.
That's great. David, how about from your end?
Yeah, it's a great point. Even there's a lot of retailers following suit there. If we take a step back and look at what was happening in the mall before COVID, there was traffic deterioration was happening due to department store failure around the country. Then the pandemic came and just kind of fueled the fire of the relocation from the mall to open air. The malls, they're not flexible formats like open air shopping centers are, where you can easily set up things like curbside pickup. And again, access and visibility are paramount, and they're so much better in our asset class. And on the cost side, we can be incredibly competitive. The operating expenses at enclosed malls are often up to 10 times what ours are. So as a result, we've been executing leases with many mall native tenants like Sleep Number, Bath and Body Works, Foot Locker, K Jewelers, Vision Works, and many others. And to be frank, they're looking to capitalize on the convenience and flexibility and proximity of our shopping centers to the customer. And also the increased demands for buy online, pick up in store, which can easily be accommodated in our format. Also, I'd like to mention, we're hearing from a lot of our retailers that the reinvestment projects that we're doing across the country, they're starting to notice that our shopping centers look better. And we're talking to retailers that maybe wouldn't look at our asset class in the past, but now they know that we're going to put real money into them. We're going to make them relevant to the communities they serve. We're going to put good uses in them and make them look great. So we're attracting uses that we're really excited about.
Great, thanks, David. Why don't we open it up to the group now? We do have the Q&A functionality at the bottom. If somebody wants to type a question, I'm happy to either answer it or ask the group. But if anybody wants to speak up, I know Todd had the hand function there. If anybody wants to speak up and ask a question, that's fine. Alex, you want to go first?
Sure. I couldn't figure out the little hand thingy.
There's that too, yeah.
So the Wren Kitchens is pretty cool. I've never heard of that. Hopefully they don't price cabinets the way they do in the New York metro area for us suburbanites. Otherwise, you guys are going to have some really great sales. But you mentioned J. McLaughlin, Vineyard Vines, Sleep Number. Like these are sort of all upscale tenants. Mm-hmm. And my question is this just the standard sort of propaganda that you're showcasing to the street? Hey, here's some great tenants, but in reality, it's the same sort of generic tenants you have. Or are you seeing a real material shift in the tenant base where if we were to tour a sampling of Brixmor centers, we'd really see a steady upgrade of the tenants? I'm just trying to gauge, these are great wins. Are they representative or are these some just, great examples?
What's been incredibly exciting for us is that our core tenants, like the Burlingtons of the world, TJXs of the world, we continue to do a lot and to grow with them. And we were doing a lot with Chipotle and Starbucks, and now we're doing even more. And the fact that these investments that we've made are allowing us to do business with people we've never dealt business with before. So I think as you start to see these come through, and we've highlighted examples of places like in Newtown, places like Marco Island, places like Mamaroneck, we're upgrading the portfolio. And when we're doing that, we're opening the door to these conversations with tenants that frankly hadn't looked in our portfolio in the past. So I'd say it's a bit of both, but we're really encouraged by what we're seeing both from our typical core tenancy and then those that we've been able to add.
I had a question. In terms of these drive-throughs, who puts the money out up front, and then how are you reimbursed by the tenants who get the drive-through built?
Tanya, you want to take that?
Sure. It varies, but typically the tenant is the one, if it's an existing tenant that we have that we're trying to accommodate a prototype shift to them in a current asset, for instance, Chipotle. They've approached us to be proactive on several of their locations where they're already a tenant to see, can we even accommodate a Chipotle in there? They pick up the cost for that. So they would actually handle any engineering entitlements in conjunction with our support and making sure that it does not do anything to negatively impact the shopping center. But from a cost perspective, they would handle that. On new deals, every deal is structured differently. We have the flexibility to do ground leases, which many of our tenants are open to, where they spend all of their capital on the investment. Or sometimes we'll do a build to suit for Chipotle's and Starbucks that have the strong credit and they have the wherewithal and the sales to support that cost investment with the rent that they pay.
And do the cities and jurisdictions have any zoning requirements before you can or cannot put in these drive-throughs?
They do, and that's where our support comes in with respect to entitlements. If it does need to get some sort of variance or approval from the local municipality, because it is still in our shopping center, we will be supportive and walk through that process with the tenant. Sometimes we do it if it's a more complicated municipality or in cooperation with a larger redab. We actually would handle the entire entitlement process. What we're seeing in municipalities is they understand now that drive-throughs are such an essential, necessity for businesses. They're being a little bit more open, but we are also challenged with making sure we don't do anything in our shopping centers that's going to cause so much congestion that it backs up onto the community's infrastructure. So we're very, very cognizant of that and working with them in that realm as well.
Thanks.
Thanks, Craig. We've got the hand, I've got it up here. Handel has the next one, and then Todd and Mike. So Handel, how about from you?
Hey there. Thanks, guys. Thanks for taking my question. First one, just real quickly, I'm curious if you're aware of losing any deals to any mall competitors today, and if so, why do you think that might be the reason? And then I'm curious if you're doing more percentage rent-based deals, and are you structuring them with lower upfront ABRs, but also lower percentage rent thresholds, which could get you the same place economically, but might give the tenant a bit more breathing room near term. Thanks.
David, I can't recall us losing a deal to a mall offhand. So Handel, if it's happened, it's been de minimis. And same thing on the percentage rent side. We often have, for some of our restaurant tenants, we have some percentage rent upside, but the number of percentage rent deals that we've done in the portfolio has been de minimis, probably about a handful. Thank you. Why don't we go to Todd?
All right. Yeah, thanks. I guess a question around your redevelopments and the anchor repositioning pipeline. I guess with the improved demand environment that you're seeing, are you seeing an opportunity to pull forward more projects than you were previously? And are the economics and yield expectations improving with some of the increase in demand and perhaps where rents are stabilizing at and or trending higher?
Brian, you want?
I can take it. Yeah, for just on a return standpoint, we're seeing returns in line with where we've been historically. I mean, Jim's talked about our rent basis, and it puts us at a really strong advantage. I would say that where the pipeline sits, we expect to bring a number of the projects forward on our future pipeline. It's one of the reasons we have it there on the supplemental, so people can see what's coming down the pipe. We continue to add projects to that. So yeah, I mean, our expectation is we're going to continue to pull those forward. What was the second part of your question, Todd?
Well, that was it. If you're, about pulling forward projects and the economics and yield expectations, with that though, I guess just following up, you talked about some of the new store formats and the prototypes and some fleet expansions. Is there enough inventory for these retailers to meet the growth goals that they're talking about? And do you expect that this demand might result in an increase in shopping center development?
We don't see an increase in shopping center development because the catalyst large format retailers that were driving that in the past still aren't doing a significant number of new stores that would be the catalyst. And then from a new construction standpoint, just the economics aren't there. I think what you're seeing, the demand that's out there, is really what we've demonstrated and others have in the portfolio. It's the repositioning and upgrading of retailers as there's some fallout in whether there's troubled tenants or certain categories. So I'd expect that would fuel the bulk of new demand. But one of the things you're mentioning, though, is actually creating a lot of competition for space. And so that's ultimately going to lead to the best result. It's kind of some of the things that David had touched on earlier in terms of just the level of demand and competition in some of these boxes. David, I don't know if you have anything else to add there.
It just feels like there's so much more competition, so many more players in specific categories that are driving competition on boxes, which ultimately allows us to pick the best economic and the best economic deal and the best operator. It's really put us in a good position. I was in a lot of meetings today where I was talking to a grocer and I had 3 other grocers interested in the same space, or a home improvement guy and I had 3 other home improvement guys. So it feels good to be here.
That category in particular, we've had a significant amount of competition. It's amazing when they realize someone else is going, that how the competition picks up. So we had a number of projects where we were talking to specialty grocers where we've had 2 or 3 that are vying for the space. Thanks, Todd. Mike Muir, why don't we go to you?
Yeah, in terms of seeing tenants come from the malls, is it largely just struggling, second or third mall in the market, or are you seeing them come from more dominant centers too?
David, you want to take that?
Yeah, I think it's a combination of both. We heard from retailers over the years that would say, look, we'll do mall and we'll do open air strip. We're just going to choose by what's available and what the market calls for. And now that's really evolved into retailers saying, no more malls, we're moving them all to open air strips. So in that scenario, they're going to leave the A malls and the A centers to come to open air because that's their company-wide initiative.
Got it. Okay. Thank you.
Thanks, David. Thanks, Michael. Samir, how about from your end?
Yeah, Brian, no, thank you for this. I know you said demand is broad-based, but can you maybe provide a little bit color on kind of, are tenants looking for, are they focused on certain regions, whether it's geographically, the Sun Belt or Texas markets? We've heard a lot about migration of population and corporates. So trying to see what, kind of what you see geographically here.
Yeah, why don't I'll let everybody, why don't I let the team take that too? Tanya, do you want to start?
Sure. Definitely some migration occurring to Florida and retailers acknowledging that. But I will say also, we talked a lot about white space in the Midwest, even some on the West Coast. And a lot of it for the peripheral land users are that they had not expanded into every state yet. So their white space was relatively broad, or they're actually seeing that they can do a smaller prototype with some sort of pickup or drive-through in smaller markets. So it opens up areas that they would not consider before, which is, again, opening up white space geographically across the country. And then regional players, I say regional, Whataburger, for instance. There's a lot of states that Whataburger is not located, as well as Raising Cane's. Those are the types of tenants that we have in our port, or that we're talking to. But historically, it's been very regional versus across the entire portfolio. So Eve, I don't know, and David, what you saw in your meetings today.
Yeah, I definitely heard there's a lot of growth where there is that migration, but still a huge amount of demand for the Northeast, for the Midwest, and the West, as you mentioned, Tanya. So definitely a lot of demand for assets all over the country.
Florida's hot, not only temperature. My favorite line. I think about tenants who are well saturated across the country, TJXs of the world, PetSmarts of the world. They're looking to go where there's very little competition in smaller, more rural locations. And then there are retailers who have pockets of growth in the dense areas in the Northeast because even against the migration that's happening. But there is a lot of talk about migration out of the urban cores and into the suburbs where our shopping centers are located. And retailers are following it. They're looking for the growth. They're looking for the housing starts. They're looking where they can pick up white space and grow store count.
And David, I didn't
And I would just-
mention concepts. I talked about prototypes, but not new concepts, new brands that are being spun off as well. So, like Sierra, for instance, on the TJ side, they've got a lot of white space for new concepts that is definitely being impacted by migration, but, they can hit a lot of markets across the US and still not be cannibalizing existing stores.
And then Samir, the thing I would just add, I agree with what everybody said, but the Northeast has been particularly hot from a grocery perspective on the specialty grocery side. And whether that's independent operators like the North Shore Farms we just opened here in the Mamaroneck, or the Stop and Compare that we opened outside of Boston, we're seeing Aldi and Lidl's doing a great job with the Best Yet Market acquisition that they did in Long Island. Sprouts is working their way north. So we are continuing to see a tremendous amount of specialty grocery activity come into the Northeast, where the mindset, to David's point, we did sit in a lot of meetings where, as David said, Florida's hot, but on the grocery side, we're seeing a lot up here. Thank you. Why don't we head to Katie?
Great, thank you. I'm curious what retailers are saying about the risk of wage pressure and higher shipping costs, and to what extent does that come into your leasing conversations, and how they're thinking about enhancing their ship from store capabilities?
We can certainly talk about wage pressure. I think it's more from an overall labor perspective. I think there's some challenges for sure finding labor and costs to retain that labor in the current environment. It came up in a number of our conversations today, really across the board, whether it was restaurant tenants or some traditional soft goods retailers. It was certainly something that was discussed. It hasn't impacted, I would say, from just an economic discussion. I think it's something that they're just dealing with and seeing how they can prepare and have incentives to improve their labor force. As it relates to ship from store, that's something that's here, we believe, to stay. And it certainly came up relative to a conversion for some of our larger retailers, converting a portion of that store to be able to ship from store. As David mentioned, a number of his tenants that he's working with have enabled curbside pickup. So there's a number of things within the store I think that the tenants are doing. And we did hear from them today in terms of prototype and the size of the store, that they're integrating that really across the board.
Thanks.
And I think it's also worth highlighting, Brian, that they're making significant investments in the technology to make them better at fulfilling out of the store and to make their curbside pickup more efficient. And that was a common theme. So we're excited about what that means for our portfolio.
Brian?
Yeah, thanks, Jim, for sure. Yeah.
Brian, why don't we go to the questions from the audience and the Q&A functionality, and then we can flip back here. That's okay.
Okay.
Do you want me to read it?
Yeah. So I'll read the first one from Stuart. Can you take a step back and speak more broadly about the format of this ICSC overall level of activity compares to prior recon years? Are there objectives for this ICSC different activity indicative of general recovery, more market share, et cetera? So from the first part of this here, Stuart, and I'd love to hear from really everybody on the national account team. This format's been really powerful for us. This is our fourth virtual conference that we've done, and despite there being I think everybody talks about Zoom fatigue. We certainly talk about it here a bit. The team was able to put over 300 meetings together, and we sit in leasing committee, and we've sat in leasing committee over the last year. And no matter what, almost weekly, there's a deal that came out of our fall into deal making or spring into deal making. And we're expecting the same here. And people got really excited about it. And some of the things that the meetings just didn't happen today, you know, Eve would reach out and say, hey, can you meet on Tuesday? And they said, why don't we just have our portfolio review tomorrow? What this has enabled, this format, a bit different, is to David's point earlier, some of the tools that we have, we can just pull right up on the screen. And you can get people at their desks for a longer period of time. So we may have had longer windows to be able to interact with retailers than jamming 30 minutes into an ICSC meeting, which are of course important, and we do miss the spontaneous things that come out of those meetings. But this is, if you think about permanent shifts that happen, we will have this as part of our repertoire going forward because it's been such an important feature of what we do. Eve, Tanya, David, I don't know if you have anything to add.
Yeah, I mean, not only are we able to share our screens and show them our tools, I was on a meeting with a retailer and they pulled up their screen. I pitched a site and they showed how it would impact their other stores in the market. And that was just something that I don't think I would have been able to do in an in-person setting, as well as they have all their data. So I can say, are you going to relocate out of that mall? And they'll tell me, look, I'm expiring in 2024. Let's circle back in 12 months. So just having that real-time feedback is so valuable. So to augment that in-person touch point with this more relaxed and data-driven approach, I think it's really valuable.
Thanks, Eve. Tanya, anything to add from your standpoint?
No, I think really you guys touched on everything. The interactive side of the technology and the ability to have also several people attend at the same time was helpful. I had, I think, 6 Chipotle meetings in total, and I broke them up with, basically married them up with their counterparts on our leasing side with the real estate managers on the Chipotle side. I did the whole country almost. I mean, we only have one more that got pushed to next week. You could not do that in Vegas, I don't think, or at an ICSC in person. So definitely something that we'll continue to do.
Yeah, and this brings up a number of different topics, but one thing I did want to highlight, and I give Eve Semler here a lot of credit. Eve said at the beginning of this that she wanted to bring the portfolio review into the Brixmor living room. So what she did last year was she brought in Restaurant Brands International, Popeyes, to come in and basically hosted a portfolio review, which we've turned into now our Tenant Spotlight series, where Eve had a Q&A similar to this. The retailer talks about their expansion plans, and then we took questions from our team. And it wasn't just our leasing team, it was our operating team. It was folks in the human resources department, Angela's team in finance. So it's been something that we've added, and it's been from a connection to a retailer perspective, it's been really strong. I think it speaks to the level of the relationships, and again, some of the trends that we'll take out of this. So I can take Jeff Walkenhorst asked about the multiple grocers vying for space, how that's changed rental rates in terms for those type of tenants. I would just say it's driven them higher. They're among the highest rent payers in that, I'd say 20 to 30,000 square foot space, particularly in the markets, like I mentioned, in the Northeast. But I also got a note from our president of the Midwest, John Hendrickson. We have 3 grocers vying for a redevelopment site of his today as we were sitting here. So it's certain competition drives rate higher. And I would say first a year ago, not dramatically. It's been fairly, I'd say, consistent, but where we have competition for space in the grocery sector, we're definitely seeing much higher rates. Caitlin, I see your hands up here. Why don't we go to you next?
Yeah, I guess I was just wondering, as you think about that idea of tenants buying for space, how are you seeing that translate into the time it takes for the tenants to actually open? Do you think that kind of pace of backfill changes, or is that kind of set in terms of if somebody's making this lease today, when that actually means that they ultimately move in?
From a I'm sorry, just the beginning part of your question. From a are you talking just backfills or from a densification out parcel
No.
perspective?
Backfills and just, I guess,
Backfill?
as you have this
Yeah.
competition. Yeah.
So, yeah, I think, look, many tenants pushed their open to buys that they had or store openings from 2020 into 2021. So there was kind of a backlog for openings. But I would say we still have robust discussions for 2022 stores and open to buys that haven't been filled yet for 2022 locations. So I don't think it's dramatically impacted the time, but timing's important from our end. And I think it's one of the reasons I touched on at the beginning of getting ahead of these opportunities so that we have deals lined up or things in place when we know we're going to get space back. So I haven't seen a significant shift. Jim, I don't know from your end if you have any comments on that.
I don't. I mean, I think that, this competitive dynamic that we're seeing emerge for boxes where we actually have tenants saying, show us all your boxes. That was a quote from one of the tenants in a recent meeting. I think it helps us drive not only better terms, but better timing. And, we're constantly focused, Caitlin, on trying to compress that time frame between, LOI and rent commencement. So generating some competition yields less comments on the lease, and helps us accelerate the time frame.
We actually had a franchisor yesterday. We did our first short form lease with a national tenant, and was saying just in terms of how seamless it can be, they're almost like demanding that their franchisees are using it, and things like that that we're able to duplicate across the portfolio have been exciting. And to Jim's point, have been able to cut down the time. Thank you, Caitlin. Craig, looks like you've got another question.
Yeah, I know you've answered in the past, but we keep hearing about rising construction costs and labor shortages. Is that starting to impact your redevelopment pipeline? If not, how are you exempt?
Well, for what we have underway today, Craig, it's largely pre-bought, but we're certainly being mindful of it in our negotiations going forward as we think about that forward pipeline. Probably less from a cost standpoint because we are seeing some nice appreciation in rents and these deals are penciling, and more from a timing standpoint. So, we're looking at pre-buying steel, we're looking at pre-buying HVAC units, we're looking at, just making sure that we can be nimble and get those tenants in as quickly as possible. But there's no question that this disruption has caused issues in the supply chain, and we just need to be mindful of that. I don't think we're seeing really any sort of degradation of return given where we've seen rents go. It's really more of a timing issue.
And I guess just the optimism I'm hearing on the call, I'm just wondering, do you expect you will see the elevated new lease volume continue for the rest of the year?
Brian, are we giving guidance on that?
This is where I look to Angela on this stuff. I would say, look, we're really encouraged. I mean, and you saw it in the fourth quarter. You started to see it in the first quarter. I think we talked about the first quarter on the first quarter call, Craig, just how strong the pipeline continues to be. So we're encouraged and we're excited about it. And it seems like each month continues to improve. So that's Angela, was that a good guidance answer?
I think that was great, Brian. I would just kind of echo what the team said. I think I sat in a lot of meetings over the last couple of days, and there's a real sense of urgency about, locking locations down and getting through, from the LOI to lease process as quickly as possible, understanding that across different retailers open to buys, they're going to have delays, right? Just as a result of what's going on broadly. And so I think sponsorship has become increasingly important. Working with construction teams they know and have been successful with in the past has become increasingly important. And there's just a real focus on getting things done as quickly as possible.
Thanks.
Craig, and I would just add to what Jim hit it on the head related to construction costs, but I would just add, we are seeing retailers too be very proactive in terms of buying fixtures out. We heard in a number of meetings, getting ahead of custom fixtures so they can hit those open to buys for 2022 and 2023. So they're starting to buy a lot of that out today and store them here. So I thought that was encouraging, at least to get ahead of it.
And value engineering their prototypes. I heard that a couple of times on phone calls, that they're being mindful of their cost, that you're sometimes passing on to us, or that's impacting the overall economics of the deal. So they're being creative as well.
It's a great point, Tanya. Simple as we'll keep the bathrooms here, or we'll utilize that facade as it sits today with some minor changes. I mean, we heard that consistently because they want to make sure they hit those openings.
Great, thank you.
Thanks, Greg. Why don't we head to Linda?
Thanks. Does the acceleration of BOPUS, given the pandemic, change the longer-term growth outlook for grocers? I guess said differently, the current trend of grocers opening new stores, do you think it's sustainable since it's a relatively mature industry?
I think the grocers are telling us it's sustainable, Linda, just because of the depth and quality of the tenants that are expanding. And nothing was more important last year than being close to the consumer. And I think a pure e-commerce model, we heard that from a number of grocers, just still isn't profitable. So you have to have BOPUS, and to have BOPUS, you got to have a store. And I think what we're finding, particularly on the specialty side, is much more adoption and a need to fill in to get as close to the consumer as they can. So I would continue to expect there to be a good runway for grocer growth. Jim, I don't know if you have anything to.
I would really echo that and appreciate from the comments from the grocers themselves how important the store is and how central the store is to meeting the customer where the customer wants to be met. And as I alluded to earlier, I'm very encouraged by the capital these grocers are putting into improving the efficiency of the micro fulfillment, buy online, pick up in store, and the investments that they're making there in our stores. And these strategies involve utilizing the store and in the most profitable manner, passing on the highest cost of that last mile to the consumer through the BOPUS model. So I'm really encouraged by how the grocers through this period of time have done well. They've gotten good cash flow. The food price inflation's helped them. And importantly, they're investing in getting better, which I think it bodes well long-term for the industry.
Thanks, Linda. Thanks, Jim. Why don't we, Alex, you've got another question.
Yeah, and sorry to keep, I know I've asked this in the past, but you're fresh off of leasing meetings, so I figured it's probably a good time. The 180-degree change in appetite, et cetera, from the retailers for physical retail is incredible, right? So it's been over a year since the death of retail narrative. Even the Wall Street Journal doesn't even write about death of retail, which is shocking. When you speak to your leasing counterparts, and maybe Tanya or Eve or some of you folks, are these the same people that a year ago or 2 years ago, they may have said, look, I really want to open up more stores, but corporate is telling me no? Or they personally, a few years ago, felt like, oh my God, physical retail is not where we want to be. I need to be really careful. I'm just curious because you all mentioned this outrageous demand. They, multiple bidding wars, people want stuff today. And yet, are these the same people that you were talking to 2 years ago? And if that's the case, they were either being told by corporate, hey, don't do it, or they were nervous and they were believing the same headlines that a lot of people were reading.
Well, Alex, I might maybe jump in here and then let the team answer it. I don't know that there has been that dramatic of a shift in the narrative. I think part of what you're hearing from us is a lot of optimism generated by the increase in breadth of demand from a number of these retailers. But go back and look at our earnings commentary. These tenants were all looking to open stores, maybe just fewer stores based on what their pipeline goals were in any given year. But I think what was consistent even a couple of years ago was the realization by the better retailers how important the store is to their business model. And if anything, rather than reversing that, the 180 that you used, I think the pandemic just accelerated that realization across the board. By the way, the teams at most of these retailers are the same teams that we were talking to a couple of years ago. There hasn't been a shift from people saying they want to be in the e-commerce initiative to being on the store side. So, Brian, I'm sorry.
No, that you hit it on the head. I think, look, certainly there was a period last year when we were at the height of the pandemic where there were more challenging discussions. But I think as there was daylight, you were certainly seeing it get back on a path that, as Jim said, kind of accelerated from the retailers that were opening stores previously, and this has shown the importance of the store. So I think that's what you're seeing from an expansion standpoint.
Other thing is that fulfillment. I was just going to add, so Target, for instance, they think very strongly that the physical plant must be integrated with their digital platform. And I think 80% is the number that they have fulfilled. 80% of their online sales are fulfilled in their stores. So it's a mutual benefit, the physical plant part of it, as well as the digital online.
Thanks, Tanya. I'd remind everybody, we still have the Q&A function if anybody wants to ask a question, or does anybody else? I don't see any hands up. Does anybody else here have any final questions? Okay.
Where's the cocktail party, Brian?
Couldn't make that first, so I wish we could. But like this is great seeing everybody, and we look forward to doing this again. It's something we look forward to every year, and we love talking about what we see in our meetings. So I really appreciate the opportunity for all of you to meet Steve, Tanya, and David in particular. They're the brains of the operations. They've been working incredibly hard to keep focused on future opportunities with their tenants really throughout the last year and a half, and it's really done a fantastic job. So I'm really, really happy y'all are able to meet them. So
and hopefully we'll see you hopefully we'll see you in December for the next download. Put that on your calendar. Hopefully you all can make it.